On this special show, I'm going to introduce you to three very interesting men. Men who've lived through not one, not two, but over 20 years of market ups and downs. And their perseverance has resulted in them being stronger, wiser, and far wealthier. We're going to find out from them what the secret is to investing in the Indian stock market. And I do hope that their story inspires you and your investments. Our first inspiration is a man who turned a tiny three-member team into one of India's largest financial advisory giants. Let's meet Rashesh Shah, the chairman and CEO of Edelweiss.
Rashesh Shah founded Edelweiss in the year 1996. The company today manages over $600 million, or approximately 3,300 crore rupees worth of assets.
Rashesh, thank you so much for spending time with us. Happy New Year to you, first of all, before we get started. And I'm obviously going to start off this conversation by asking you, and this is the question that all of our viewers want to know. According to you, if you can put it in a nutshell, what is the secret to making money in the Indian stock market?
It requires a lot of patience, a lot of calmness, a lot of outlook for long term and incremental improvement every day. It won't happen automatically. You buy a stock and suddenly you will make 3x the money. So I think investing is a habit. It requires, patience and discipline and a very structured approach to it. And people have to approach with that. So I think ultimately the formula is not very complex, but executing on that formula takes a lot of hard work.
So we have a lot of investors who've written in today saying, how do I get started? Because they want to start investing in the market. They're new to the market. For a retail investor sitting at home, if I'm going to pick a stock today, what should we keep in mind? Is it the financials of the company? Is it the management team? Is it the fundamentals? Should we be looking at the stock track record? How would you recommend we choose our stocks?
I think ideally from whatever savings that investor has, he should split it between what is he going to require under 5 years and what is above 5 years. So I think you should segregate your savings in that. Down what you have for above 5 years. You can very easily put it in equities, because over a 5-year period, generally equities will give you a much higher return after tax than anything else. And then you come to the second point, which is a very fundamental question. Should you just buy the index or an ETF or just a broad mutual fund, which is the easiest to do. However, if you also want to invest, and I think it's a good thing to try and invest on your own and learn about that, if you have the time and you can invest in the effort in that, you should then start by investing in the top 100 companies or 200 companies. That's a safer way to start. And the best way, the easiest way, is to look at companies which have a good track record, good governance, and a good management.
Okay, so let's talk specifics now. We've heard a lot of talk in all of our newspapers about reform from the government. Do you believe that in the new year the government will be able to see through this reform? And as a retail investor, how much of that reform will actually affect my investment?
I think on the whole, the government is very committed to getting this done. And they may not be able to get everything done because there is a lot of a give and take that will go on. If the government goes through with the reforms process and opens up the economy and the financial sector and the retail sector, we do expect that it will spur GDP growth by between 1 to 2 percentage points. Like for example, the GST, it's a very big thing in India. If the government can manage to get the GST done before March, we think it will add between 0.5 to 1 percentage point to the GDP growth rate. So we'll come out of this 5.5, 6 range we have and at least go to 7, 7.5, which itself is a good thing. So I think these reforms will add growth to the Indian economy again, which has gone away in the last few years, and that will translate into corporate earnings growth rate and stock market returns, because foreigners have already started coming to invest based on the expectation of these reforms, going forward.
So in reforms, the sectors that we normally hear being talked about are the financial sector, the retail sector like you mentioned, and the aviation sector. So if I'm looking to put some money in the stock market right now, among these three, where do you see the strongest value?
I think the financial sector, especially the banks, because I think banks, there are a couple of things that are in your favor. One is it's growing at 25-30% a year because people are saving more money. If the economy in real terms is growing at 7-8%, you say 6 to 7% a year, and inflation is another 7%. The nominal growth is only 14-15%, and usually financial sector grows at 2 times the nominal GDP growth. So it's a sector that is growing at 25%, 30% a year. The banks are fairly solid. A lot of them are owned by the government of India, so they're going to be very reliable.
So are you saying private or public sector banks here?
So I think the market has efficiently priced both the opportunity. One is, let me call it a value opportunity, and other is a growth opportunity. So depending on your inclinations and all, I think either can work, or maybe having a combination of the portfolio of both, because there are banks in the private sector which will continue to grow at 20-25% a year. They are reasonably stable. They are but the pricing has already factored that in.
Well, you did mention that there are some high risk sectors that we should stay away from, and this is a question we get a lot, where investors write in saying there are sectors with a lot of policy volatility that we can't really predict. There's oil and gas, there's telecom. You don't know what's going to happen tomorrow. Then there are sectors like real estate and construction that are risky. As retail investors, should we completely stay away from these sectors? Is that what you'd advise?
These are all trading sectors. They are not investing sectors in that sense. But for an average retail investors, you should only stick to investing. But I'm sure you have quite a few viewers who are both have an inclination for investing and trading. We don't think trading should be more than 8-10% of your portfolio.
As a New Year's gift to our viewers, is there a sector that you think is going to do well over the next, other than banking? You've talked about banking already. Something that we wouldn't have otherwise found on our own, because we don't have the access to the kind of research that you do. Is there a gift that you'd like to give our viewers in terms of a find in the market right now that you can share with us?
We do believe that pharmaceuticals is still a very good sector to invest in. It's not as dependent on government policies. It is more dependent on the export market. A lot of pharma stocks are doing very, very well. So there could be a good, fairly good upside on that also. And we do believe that this is a year, the pharmaceutical sector has already given good returns to investors in the past, but we don't think the story is over. I think the story continues in that.
I also want to ask you, since we're talking about counter-cyclical investing, you've mentioned this several times in the past. Is this something that we can use as retail investors? Can you explain to us how we can use this?
I think counter-cyclical, investing is usually the best strategy. I think every book says that when there is greed and fear, when everybody is greedy, you be fearful, and everybody is fearful, you be greedy. Which means when the markets are bad, you invest, and when they're euphoric, you start exiting. Investors, if you take a 5-year view, buying on dips, buying when there is gloom, doom, buying when, and especially buying good companies. I wouldn't say buying, completely downtrodden companies, but buying good companies when the environment is bad is what I call counter-cyclical investing. Now,
the interesting thing about being a retail investor today is the amount of information that's available on stocks, on the market, on the global scenario, on macroeconomics, and all of these various talking heads that we hear on a regular basis. Can you tell us what we should be tracking and what's relevant to our stocks and to our portfolio?
What we have found is having some simple rules of thumb always helps. I think to have that faith is the first point, which is you will make about 14-15% annual return over a 5-year period if you invest in the market. So that is the first simple faith or rule of thumb you should have. I think along with that, as I said earlier, whenever there is a huge selling by foreigners, because they usually sell when there's a global event or there is some big scare about India. Usually investing on the back of that has been a good thing for investors. Investing in good companies, one of the simple things to do is to look at the growth rate of the companies in the last 10 years, the earnings growth rate of a particular company. And if that company has grown at 15-20% a year and more on a steady basis, usually it's a good investment.
Let's be honest, a lot of retail investors get very excited when IPOs start to come in, and that's normally when we start to enter or re-enter the market. Do you expect to see a strong primary market next year?
I've seen that investors tend to be blind while investing in the IPO market, and they do a lot of work on the secondary market. I think they both have the same kind of risk in investing. If at all, the risk of investing in IPOs can be slightly higher, so investors should put in slightly more work in that.
All right, Mr. Shah, we wish you a wonderful new year, And we hope to catch up with you again several times over the new year. Thank you.
Yeah, and same to you. Happy New Year to you and all the viewers.